Ever wondered what makes a stock hard to borrow? What does it mean when the cost of borrowing shares skyrockets, and why does that get traders excited about a potential short squeeze? Today, we're diving deep into a specific company that's currently lighting up our hard-to-borrow screener, VRAX Biolabs Group Limited, ticker VRAX. VRAX operates in a fascinating world of healthcare and biotechnology, and its recent activity offers a perfect case study. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. VRAX Biolabs Group Limited, based in the UK, US, and China, is a biotechnology company primarily focused on immune response detection, T-cell immune profiling, and developing in vitro diagnostic technologies for viral and immune-mediated diseases. They offer a key product called VRAX Immune. Their company logo/info with a current market capitalization of just $3.01 million, VRAX is firmly in microcap territory, and its estimated float, or the shares available for public trading, is a tiny 0.8 million shares. Looking at the charts, VRAX has seen some mixed action lately. Today it stands slightly by 0.26%, but over the last 5 trading days, it's up a respectable plus 12.46%. Zooming out, the last 30 days show a larger decline of minus 25.74%. Today's volume sits at a very low 76,400 shares, a stark contrast to its 30-day average volume of over 3 million shares, meaning relative volume today is practically Xerox average. To chart with price action and volume. What is cost to borrow and why it matters? So, what makes VRAX so interesting right now? It comes down to something called the cost to borrow, or CTB. Imagine you want to rent a car for a short period. If that particular car model is rare or in high demand, the rental fee goes up, right? It's similar with stocks. If a short seller wants to borrow shares to sell them, hoping to buy them back cheaper later, they have to pay a fee to the lender. This fee, the cost to borrow, is usually expressed as an annualized percentage. A high CTB indicates that there's either very high demand from short sellers, a very limited supply of shares available to lend, or both. For a stock to be hard to borrow, it means exactly that. Lenders are making it expensive because shares are scarce. Why this stock is hard to borrow right now? And VRAX? It's currently extremely hard to borrow. Our data shows an annualized cost to borrow fee for VRAX an eye-watering 680.2%. That means if you wanted to short VRAX for a full year, it would cost you nearly 7 times the value of the shares just in borrowing fees. While the CTB is astronomically high, we have seen some recent CTB momentum with a decrease of minus 60 percentage points over the last 5 trading days, meaning the fee has come down slightly from an even higher peak, but it's still exceptionally elevated. Highlight CTB number. Adding to this scarcity, there are only about 35,000 shares currently available to borrow for VRAX. Compare that to the tiny 0.8 million share estimated float, and you can see why supply is so tight. Our internal composite squeeze score for VRAX, which combines factors like CTB, borrow supply, float size, and price momentum, currently sits at 41.7 out of 100, indicating a moderate but notable squeeze potential. Squeeze mechanics explained. Let's break down what this hard-to-borrow situation could lead to: a short squeeze. Show animation of short squeeze. When a short seller bets against a stock, they borrow shares and sell them, hoping the price falls. If it does, they buy back those shares at a lower price, return them to the lender, and pocket the difference. But what if the price goes up instead? The short seller starts losing money. With VRAX's incredibly high cost to borrow, those losses are compounded by steep daily fees. If the stock price continues to rise, and the number of available shares to borrow shrinks further, like VRAX's mere 35,000 shares, short sellers face increasing pressure. They might be forced to buy back shares to limit their losses or fulfill margin calls from their brokers. This forced buying creates a sudden surge in demand, which pushes the price even higher, trapping more short sellers, and forcing them to buy back shares too. This cycle, where buying begets more buying due to short covering, is what we call a short squeeze. Dilution risk check. One critical factor that can negate a short squeeze thesis, even with high cost to borrow, is dilution. Dilution happens when a company issues new shares, increasing the total number of outstanding shares. This can flood the market with new supply, offsetting any buying pressure from short covers and providing new shares for short sellers to close their positions with. It effectively acts as an escape hatch for shorts. The good news here for VRAX is that our screen found no recent dilutive SEC filings such as SMINUS1, SMINUS3, or 424B in the last 90 days, which often signal new share offerings. So, for now, dilution risk appears to be low. Recent reverse split watch. Now, something crucial to understand about VRAX's recent past: the company executed a 1-4-25 reverse stock split on June 26, which was exactly 25 days ago. Highlight reverse split data. Reverse split means that for every 25 shares an investor owned, they now own 1 share, but the share price is adjusted upwards proportionally. So, a $1 stock becomes a $25 stock, and the number of outstanding shares is drastically reduced. For VRAX, this significantly reduced its float and reset its share price higher. It's important to note that many microcap stocks historically tend to see renewed volatility or price pop within about a month after a reverse split. This isn't a guarantee, and microcaps are inherently risky, but it's a pattern we observe and something to be aware of when looking at VRAX right now as it approaches that 1-month mark. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. It's essential to remember that a high cost to borrow like VRAX's 680.2% does not guarantee a squeeze. It can also signify that short sellers have very strong conviction that the stock price will fall further, and they are willing to pay a premium to maintain their short positions. For VRAX, if you're watching for potential squeeze catalysts, key indicators would be a significant increase in daily volume, well above its 30-day average of 3 million shares, coupled with sustained positive price momentum. Should volume bars any further drops in the shares available to borrow, currently at 35,000, or a reversal in the recent CTB momentum leading to even higher fees, could also add to the pressure. Remember, our composite squeeze score of 41.7 is moderate, not indicating an immediate explosive move. In summary, VRAX Biolabs, VRAX presents an intriguing case with its tiny 0.8 million share float, an astronomical 680.2% cost to borrow fee, and a very limited 35,000 shares available to short. Add to that the recent reverse split and the absence of immediate dilution risk, and you have a stock showing some of the ingredients often associated with short squeeze potential in the microcap biotech sector. However, the current low volume and the inherent risks of microcap investing cannot be overstated. If you found this breakdown of VRAX helpful, please hit that like button, subscribe for more deep dives into hard to borrow stocks, and let us know in the comments what other stocks you'd like us to analyze next. Thanks for watching.